from our panel and the moderator, Lisa Berlowski. Lisa, on to you.
Very good. Thank you so much, Marina. Hello, everyone. I am Lisa Berlowski. I am the Global ESG Coordinator and Vice President Business Operations at Brookfield Property Group. I'm joined today by a panel of distinguished ESG experts. And I think we've put together a very rousing panel discussion on ESG. So what I'm going to do is I'm just going to introduce our panelists right off the top and then pass it over to them to give you a sense of what they do in their day-to-day. So together today we have Jill Brosik, Managing Director and CIO, Harrison Street, Matt Ellis, CEO, Measurable, Jessica Long, Head of Sustainability for the Americas, Nuveen Real Estate, and Christopher Wright, Head of ESG Risk Monitoring, Investment Risk at Norges Investment Management Bank. So, ESG can mean so many different things. It's a broad umbrella topic. I'm going to put you all on the spot as I pass it off to you. It can mean so many things, but if you were to distill it down to one thing right now, maybe it's something you're working on, something topical, something of your mind. What does ESG mean to you right now in your day-to-day? Maybe I'll pass it off to you, Jill, to get us going.
Sure. So let me go ahead and first give a little bit more of an introduction of who I am and my company, and then I'll answer your question, Lisa. So thank you. So yes, my name is Jill Brosig. As was mentioned, I am the Chief Impact Officer for Harrison Street. And for those of you that are not familiar with Harrison Street, we are an investment manager. We invest in real assets. So things like senior living and student housing and healthcare, life science, storage, and even infrastructure. And my background personally isn't really in real estate. It's actually in energy, it's in technology, and I come from the business operations world. In my role, however, what I oversee is the management and the reporting of environmental and social factors that we report on a quarterly basis. So Harrison Street as a company, we've had an ESG formal program since 2013. That was actually the first year we submitted to GRESB as well. And our overall ESG strategy is pretty comprehensive, and it's broken into two parts. One is where we focus on our firm, and the other is where we focus on our investments, our assets. And key elements of the firm, they include things like a dedicated focus to diversity, equity, and inclusion. We have a really strong focus on our culture. We want to make sure that we're attracting and retaining our team members. We work very closely with our operating partners. We invest in the assets, but we don't do the day-to-day management of them. So we work really closely with the operators that are doing that, and we support them and we guide them in helping them improve their business activities, whether that's improved performance, whether that's market differentiation, whatever it is. And we do that typically by sharing of best practices and implementing new technologies. And then the second facet of our ESG strategy really does focus at the investment level. And that consists of things like the creation of sustainable communities. How are we creating jobs when we make an investment? We want to make sure that our buildings, that they're operating and they're designed to be healthy. We want to make sure that we understand how our assets are interfacing with the climate. We're looking at how resilient they are, but we're also looking at what are they doing that could be negative to the environment. What type of GHG emissions are they giving off? And we also are very focused on investing in renewable energy. So this entire strategy on both sides, we follow leading frameworks. I mentioned, GRESB, and we're signatories of TCFD, UNPRI, and we also, all of our goals and strategies align with the various aspects of the UN Sustainability Development Goals. And then to answer your question, Lisa, I will say it's very difficult to narrow it down to one thing because we're talking about the E, the S, and the G. So what we do on a regular basis is we conduct a materiality survey with our key stakeholders. We look at what our investors think, what do our partners think, what do our employees think, what's really happening in the industry, and what's most material as it relates to E, S, and G. And we finished our last survey, or our most recent survey was done in February of 2020. And the top things that boiled up fit in those three categories. On the E side, it was around climate risk and resiliency. No surprise, it was in the middle of all those Australian wildfires. Carbon emissions was in there too. On the social side, it was around health and wellness. And on the governance side, it was around diversity diversity, equity, inclusion. So we really try to, those are kind of, it's hard to say it's just one, because I truly try to look at it as a comprehensive strategy, but those would be the ones that I would say under each of the E, S, and G that we're focused on.
That's a very thoughtful response, Jill. And I just wrote down the word materiality, right? Because we are focusing on so much. And so to hone into, what aspects can hit value is very important in this area. Thoughtful response. Thank you. Matt, how about you? What's your take on this? And please give us an overview of Measurable and what you do and where you sit.
Thanks, Lisa. Pleased to be here. So I'm Matt Ellis. I'm the founder and CEO at Measurable. And unlike my fellow distinguished panelists, I am not an owner or an operator of real estate. I'm in the business of building the enabling tools and technologies to take ESG to scale. So for us at Measurable, that means really connecting a lot of the traditional boiler room issues with, that we see E and environmental sustainability as we actually know it, with the boardroom issues, S, G as well, and really connecting that on the platform is our goal. The business is a tech platform that serves REITs, asset managers, about 11 billion square feet, 80 countries, and something like 2 trillion in assets are on the platform today. So that's what we're up to. And your icebreaker question that you served up, ESG can mean a lot of things. If there's one ESG consideration you hold close day to day, for us, our technology is quality. If I think about the real estate business, it's easy to brick and just not that. That's shade and shelter for occupants, I think. But really, this is a business of moving debt and equity into those assets and generating returns on the other side at its most basic. And when I think about that, those are all transactions. They're loans, they're buy-sell decisions, they're insurance to property. And each of those is now beginning to incorporate ESG to some extent. What matters, and in order to take that to scale for the real transformation to sustainable real assets, is that we can trust this data and use this data at all in our business. Right? We have to get ESG to comparable esteem as our traditional financial metrics. If we can trust them, we can transact on them. So that's what I think about in our business day to day.
Thanks, Matt. I share the same sentiment and challenge in my job. And our CEO has made this comment many times, Brian Kingston, CEO of Brookfield Property Group. If you think about all the complicated things we do in real estate, all the assumptions, all the math that goes into this, how much diligence we do on everything, something as relatively simple as measuring our energy or measuring our greenhouse gases should not be that difficult. So no excuses. However, it is an operational challenge for a lot of companies to get this straight and to really use ESG to gain transparency into your portfolio and use it ultimately to protect and create value. Jessica, maybe if I can turn it over to you and get your take on this, and please let us know what you focus on at Nuveen and what your ESG distillation would be.
Yeah, so thank you. My name is Jessica Long. I am the head of sustainability for the Americas for Nuveen Real Estate. Nuveen is the asset manager for TIAA. And so our real estate portfolio is $130 billion globally, debt and equity. And we think of ESG really as, and sustainability as a core pillar in our investment strategy. And so I kind of separate the two and say, ESG is about investment management, things that non-financial metrics that influence investment performance, while sustainability, I try and tie a little bit more closely to the building itself and sustainable property management, the things we're doing to make our product that we're offering, more sustainable and in line with expectations of the market around environmental performance and focusing on social objectives as well. We call it our Tomorrow's World strategy as far as focusing on key areas of structural change and disruption. And climate change is the big one that I focus on. and thinking about not only the physical impacts of climate change, but also the transition to a low carbon economy and net zero carbon, and how we're going to do that as an industry. I think it's really important that we're kind of working together as an industry to say this is the path to net zero. This is what's acceptable. The thing I love about the real estate industry is we're just so close. The building that I own today, one of you guys may own tomorrow, or we may even be partners on in some cases. And so making sure that we're all on the same page of where this is going and the expectations are clear. I think uncertainty is one of those things that really no one likes, and none of us have a crystal ball. So we don't really know what the future holds when it comes to pricing in the risks of things that really just haven't happened yet.
Yeah, thank you, Jessica, for that. You brought up this, I just wrote down expectations of market, and aligning your program to what is expected of you by the market. I think this is a good segue, Christopher, to bring you in here, and from a risk perspective and hitting off not just the basics today in terms of regulatory compliance, but being aware of what we're on the cusp of and what, as an industry, we're going to be asked to take on in terms of reporting and regulation. And maybe you can help us unpack this while also giving us a little bit of insight into what you focus on and what you see as that ESG distillation of what is important today. I think you're on mute, Christopher.
There, thank you. Thanks for that. Sure, I can say a little bit about myself and my organization first. So I'm Christopher Wright. I'm head of ESG risk monitoring for Norges Bank Investment Management, and we are the asset manager of the Norwegian Sovereign Wealth Fund. So we have a single client, which is basically the Norwegian people, and we invest on their behalf in global markets, including real estate. And we have a wide kind of responsible investment program. We're an active owner on the listed side. We help develop market standards around reporting, for example, including climate risk reporting. And we also have various sustainable investment strategies that we pursue. And I think on the real estate side, we really see this as a commercial opportunity in the ESG space, right? So that there's long been a kind of a recognition that you can save operational costs, you can attract additional tenants through sustainability initiatives, and we really believe this remains the case, and actually has that business case has grown. So I cover all the three asset classes of the fund, including real estate, and that gives me kind of a wider perspective. And what you see is that real estate is increasingly kind of looked at as a contributing sector into a wider ambition to reduce emissions. And so oftentimes the timetables set for real estate is less linked to the kind of internal characteristics of the sector and more to the ambitions of their governments, and that creates difficulties for us. So I would say, in terms of your question about what are some of the key challenges now, there's a lot around ESG, but I can initially focus on just the climate challenge that we've already touched upon. Is what you're seeing now is this is something that many of us have kind of been expecting for a number of years, is that you see particularly city governments, but also national governments setting quantitative targets for energy efficiency or for carbon emissions in buildings that are associated with fines or some kind of coercive actions if you don't meet them. And the timetables for those are kind of set almost equally for all types of assets in those jurisdictions. I mean, there are obviously exceptions for certain things, but it kind of for some assets it's extremely disruptive relative to where they are in the investment cycle. And so this is the the uncertainty around when these regulations come into force, how strict they will be, what the impacts are on costs, how tenants will react. All of those things are kind of up in the air in a time when the sector is already being disrupted. So I think like Jessica mentioned, just the uncertainty around these regulations and how the impact on the market in the long term is something we're grappling with. And of course, it starts with measuring where you are, right? And that's something that most institutional investors, at least, have done for quite some time. And that is a challenge, right? To get appropriate data of high quality that you can use to benchmark your assets and kind of target your initiatives. But with the help of technology, that's becoming increasingly common. So in terms of what I expect is the type of regulations you have in New York, for example, and now also we see that in the French market, where there is a timetable set of targets that buildings over a certain size have to meet, and that goes directly into asset planning. You have to look at those targets in the context of your annual or 5-year plans and include it into the CapEx decisions, and that's a game changer. I mean for many. So I think the solution is for this to increasingly be integrated into your asset planning, into your strategies as a core part of what you do, and that internally in an organization, that means the integration of teams, and at the strategy level, it just means to understand how this agenda kind of impacts your broader investment strategy.
Yeah, I hear you on that, on the multitude of new challenges on the horizon, a lot of which undoubtedly plays into the huge social and business challenge that we're faced with climate change. Real estate as a sector is a major contributor, the second largest after transportation, to global greenhouse gas emissions. So I think sometimes it's a bit of a trap, but it's also a truism that in real estate, we spend a lot of time talking about the E in ESG. Let's just put on the table that it's not all about the E, but a good portion of it is, right? In our day-to-day, in our operations, in managing our portfolio. So let's start there. Let's unpack this a little bit. Jessica, can I ask you, in an operational sense, what are you focused on within the E, and how does this tie to broader climate change, environmental, green development themes? Like, where do you want to steer us in terms of E focus?
Yeah, I do think historically sustainability has been focused on the E for real estate for obvious reasons. And really because that is the way I think about it is, again, issues that have the ability to have a material impact on your business. So it's not only, again, the impact that our buildings are having on the environment, but the impact that the environment has on our buildings. And so that goes to the physical risks of climate change, and then this transition to a low carbon economy. So up until now, I think that energy efficiency and has been largely seen as, oh, okay, this is all about saving operating expenses. And now it's a little bit more of that big picture of how do I meet an energy efficiency standard? So instead of looking for low-hanging fruit or items with a short-term payback, now we're starting to look at our buildings and say, can this building meet a objective for energy efficiency? Can this be brought up to a modern day standard for energy use? I like to say resource efficiency, because I think water is something that we don't talk as much about because of the focus on energy and climate, but especially for those in the Southwest US right now, or anywhere in the Western US right now, water is a huge concern. And so our buildings, and I think that Matt put it nicely, is we're not just offering kind of, four walls and a roof. We're offering, the connection to the grid, running water, all of these things that our building or people interact with our buildings to receive that. And our obligation is to make sure that those things are running efficiently, that we're delivering those services in an efficient manner and not wasting. I use the kind of no waste as a good way to think about it, that your building is operating at its peak efficiency if you're not wasting energy, you're not wasting water, you're using only what is necessary. So I think it's really important that we understand the big picture as far as what are we trying to achieve here. Again, that we've moved beyond, okay, there may be some opportunities to save money and we'll do those. But that's about it. Now it's are we going to be able to meet this future standard? And it's so important when you go to buy a building that you plan to own for 7 to 10 years, that you understand, what is the expectation going to be at that time when you're going to exit your investment, because things are changing so quickly. If you think that you're going to buy a building, not put any capital into it and sell it at a top price in 10 years from now, you may be missing some important things that need to be done. And so having that clear picture and being able to look out into the future and understand what are the expectations in the market going to be is a really important part of integrating ESG in your investment decision making.
Jill, can I ask you to react to something Jessica said, and this idea that people interact with our building? So it's not just tracking your energy and putting in LED lightings, but it's that human aspect, the connectivity that we provide and foster. And when people are, hopefully we're all in the real estate sector, so we're hoping people come back to work, right? And forego the working at home stuff. But can you talk to me a little bit about? I'm thinking, wellness and tenant engagement, and just maybe step away from the E into the S a little bit more.
Sure. And just like the E, there's many elements that make up the E. There's a lot of things that make up the S. Like you just mentioned tenant engagement. You mentioned health and wellness. You can have job creation in there. You could have affordable housing. You can have working conditions. There's so many things. And also, to pick up on what Jessica was saying, I mean, you can have the most efficient running building. It can be zero carbon, but if it's not designed for the best experience for the occupants, and most real estate buildings, there are occupants in them. I mean, that's most of them are like that. Who cares? It's just an empty shell. So you really have to pay attention to what's happening to the people, the experience that's happening there. And if we drill a little bit into, let's start with health and wellness. Health and wellness has been a huge movement just in general. I mean, before COVID, there was a huge movement around health and wellness, and you were seeing people, they were starting to invest more in healthy experiences as opposed to material items. And given our sectors that we serve, again, senior living and student housing and medical office, health and wellness has really been kind of the part of a fabric of what we do from the very beginning. But the issue you have is, how do you measure the impact of anything that you do that's social? I mean, on the E side, we've been able to do that. You do some sort of a retrofit, you upgrade the light bulbs or you upgrade the mechanicals, and you can see your utility bill go down. I feel like where we are with social, we're probably where we were with E maybe 15 years ago or so, where, people in their heart of hearts, they know it's a good thing to do, but how do you actually measure it? And I don't want to get us in a position where people think we have to sacrifice doing something on the social side for returns. I really, truly believe that if you have a very solid ESG strategy and you're hitting everything and you're optimizing it, you actually will perform better. So for us personally, some of the things that we've been looking at on the health and wellness side, one is we've been looking at building certifications, and now everyone's familiar with, LEED certification. And I think when that came out, there had been some pushback in different respects in terms of what does this really mean for the building? How is this helping my bottom line? And of course, they evolved over time, and there had to be someone that was the first one to go out with it. So we're working with various standards that have been proven to be performance-based standards on the health and wellness side. And we've made a commitment as a portfolio that all of our occupied buildings will receive a healthy building standard. And we're doing this really for three reasons. The first is we think it gives these assets market differentiation. Again, especially coming out of COVID, and I don't want to harp on that too much, but if you're able to say that a third party has certified these buildings as being designed and operating as healthy, I think that helps attract staff, it helps attract residents, it helps attract any type of occupant to your building. Second reason we're doing it is I want to be able to say that every building in our portfolio meets a certain healthy standard. And the third reason, which is probably the most powerful, is I want to be able to get this information, going back to what I said in the beginning. If I know how a particular building is performing as it relates to health and wellness, I want to be able to translate that to performance. And once I get all of our buildings online, I'll have enough data to work on this. MIT has done some initial studies in this field already, not with our asset classes because we're more niche, but with the more traditional office, multifamily, and they've been able to determine that if you have a healthy building certification, you're able to charge somewhere between 4 to 7% more in rent per square foot. I'm not advocating that we do that because we want to raise rent. It just kind of demonstrates that there is, people see value in this and they'd be willing to pay more. They've also been able to demonstrate that these types of buildings sell for more. So I want to continue to, explore that and really be able to quantify the value. But beyond certifications, there's other things that I think we need to be a little bit more creative on the S side. We are looking at different types of technology in the social space. So there's one technology that I'm really excited about that we invested in is a digital health tool that can predict one's cognitive health. And so in our senior side, we've rolled this out to be able to predict if someone's on the path for dementia or Alzheimer's or maybe likely to fall or maybe about ready to lose their independence, so that our caregivers can provide more proactive care. On the student side, we're using it to detect when someone is suffering from anxiety, stress, depression, even suicidal thoughts. I hate to say it, but it seems like there's more and more stress in universities now. We're hearing about more suicides. If there's any way we can kind of triage some of those situations by using technology and understanding one's cognitive health, I think that's really important. And then the third thing on the health and wellness side that I'll just talk about is we've made some wonderful relationships with key partners. For example, we work with the Well Living Lab, which is a collaboration between Delos and Mayo Clinic. And we're working with them and their Kogod Center on Aging, Mayo's Kogod Center on Aging, on looking at doing clinical studies on how the indoor environment impacts one's health, and in particular, maybe even trying to look at how the indoor environment impacts aging, which I think is really interesting. So really kind of trying to think outside the box and think differently and truly think about how do you measure the S. Again, I just kind of drilled down in health and wellness. We talked about tenant engagement. That's another huge piece. I mean, maybe if we have time, I can go more into that as well. But I think anything that you're looking at on the social side, we want to be able to demonstrate how do you measure that. And it's not going to be an easy nut to crack, but I think it's possible, and that's what we're working towards to do.
Well, we have an expert in measurement on the panel today. So Matt, can we ask you, how do we measure the S? Aside, certifications aside, but on an ongoing basis, to make sure we're obviously adhering to the postulates of our certifications, but then really like levering that to deliver that amazing tenant experience and go above and beyond, providing that shell.
I would very much like to give you a satisfying and easy answer to this, and I'm not going to be able to, but I'm going to start with some personal experience I had, which is I started my career in the brokerage business with CBRE, and in that business, we dealt in face rents and TIs and free rent, and it was economics, and it was straightforward. And I was able to follow my personal interest in sustainability at CBRE, and ultimately became the director of sustainability solutions. And I found a very different reality there, which was that we were not good or able to measure more or less anything that we're having a conversation about today. This is wind the clock back. This is some 10 years ago. And there's something that's really tricky here, which is that we got ahead as an industry, I think, around frameworks and conversations about what's material to the report without starting with or paying as much attention to fundamentally capturing that data and making that data trustworthy, and doing that at some level of scale, i.e. across a whole portfolio the size of Jill's or Jessica's or Chris's. And so I feel like we skipped over this. So we found ourselves in a world where we're having a lot of conversations about what we ought to report and the schedule at which we ought to report and the actions we ought to take without any real comprehensive understanding of where this data was coming from and doing that reliably and repeatedly. It was a big block, right? And that was an awkward position to be in because we had this very objective side of our business. What are we making per square foot? What are the building buyers sell for? And then we had this other side, this imperative ESG, where we had none of these key measures. Okay, so we have this conversation about E. It makes sense because it is the one that we have had the most history with. Way back in the States, in the oil Arab embargo, we designed a net lease. We split out variable costs and our fixed costs. We said, variable costs are yours, the tenant's problem. And we, depending on your lease structure, could at least pay attention to that and track that and quantify that. So no wonder we're here today still talking about E and electrons. It's the largest single cost in most assets. But then the rise of ESG forced us to extend that a little bit into things like carbon. Well, carbon didn't have a price and it wasn't obviously measurable. You got into horrific issues of emissions factors and which emission factor to apply on which asset, and it became complicated. And this is just the things that were the most measurable in the real estate experience. You go to the place where Jill is talking about S, health and well-being. There's great studies here on the S side. I think JLL has been a real contributor talking about the benefits to productivity of a healthier environment. And isn't that what our customers, the occupiers, are seeking? And if we could deliver that experience to them, wouldn't that be to our benefit as well? But how do you measure that productivity? How do you measure indoor air quality? And I'm sure there's many of my friends in technology that will say, I have a sensor for that, but here's a problem. Deploy that sensor to every asset that Chris and Jessica and Jill own, and you're talking about a massive amount of CapEx. And you're still just focused on indoor air quality, not necessarily tying that out to some specific ROI and E. So to kind of wrap up a few thoughts on this, I think that we have made great progress thanks to our friends at GRESB or LEED or BREEAM and the various different protocols and certifications of defining what we ought to talk about. I think we skipped over a little bit about how to actually get that data and get that data reliably at scale. I think E is where we've made the best strides because it can come off a utility meter and those utility meters are ubiquitous. I think we're struggling a little bit when we move into areas of S. I think it becomes very binary at the level of G. Do you or do you not have a policy on executive compensation for climate change? Yes or no, right? But S and G or S and E, progress has been made, but we need to be very careful about what technologies are actually available at scale to get this information and provide it to the investor class, the operating class, the insuring class. We can't rely on everyone deploying $1 trillion in CapEx in the next year to get there. We're going to have to be more clever than that, I think. So a mixed answer there, Lisa, but some progress and some things to pay attention to.
Well, Matt, that was a satisfying answer. It wasn't an easy answer, but thanks for sharing your perspective there. And yeah, when we're talking about climate change and getting to net zero, you know, so much hinges on the creation of technologies that we don't have today, right? And that's a leap of faith. You know, assuming that we can get somewhere on things that have yet to be invented or rolled out to the scale that we would need for our sector. You know, putting all that aside, I think lots of jurisdictions, specifically Europe, you know, have bought into the collective goal of believing that we can get to net zero, that it is possible, either 2030 or 2050, whatever date you want to put on it. But you know, it's one thing to state a net zero ambition, and then it's another thing to get there and to report and disclose. So Christopher, can you talk to me about maybe where your firm is on this journey or what you're seeing in the market in terms of people actually digging in and acting on climate change, either because they have a regulatory push or because it's a core part of being a good manager?
Let me first address the point that Matt made. That was very, very good around these air quality sensors. The challenge, I completely agree, right? If you were to put a sensor in each meeting room in each or different parts of an office landscape, in all our, you know, assets across the world would be a huge expense. The challenge we're facing, though, is that increasingly occupiers can buy those sensors. And of course, those sensors, you can discuss how accurate they are and so on. But this information, unlike, say, energy consumption, air quality information is increasingly available for free or through kind of handheld sensors. And you have, for example, air quality indices in cities, right, to tell you which days are poor and which days are better. And so that information triggers requests for information from the occupiers to the landlords to say, you know, the street outside has very, very, very polluted air. Is that being filtered correctly, or how does it affect the indoor air quality? And it's kind of, you have to prove that you're addressing that in the right way. So that's and that's increasingly, we see that in the major cities in which we invest, that is a growing concern that will affect the owners of real estate. With regards to net zero, so where we are, we have a kind of a general strategy to prepare our assets for net zero, and we do that through our conversations with our operating partners, and also directly in the assets that we own on a 100% basis and manage ourselves. We then start out with the local market conditions, right? Because the kind of the expectations around net zero, even the definitions of net zero, vary across markets. So I think that's where you have to start, is to understand what it means for different types of real estate properties, and also different tenant markets, right? Some office tenants might have a different expectation in one city than another city, and depending on their sectors. So it's a complicated, it's a fairly fragmented field, and there might be some standardization over time, but you see that different countries have net zero regulations, and they set rules in place for achieving those ambitions. And that affects the real estate differently. So it starts with kind of building on our local market expertise, really exploiting that to understand what's happening. And then secondly is to baseline where our assets are currently, and what we have to do to prepare them for meeting a standard. As I mentioned initially, in some markets, there are already kind of standards that we can use as proxies for net zero. In other markets, there are no such standards, but we expect them to arrive at a certain date, right? So one of the things we are supporting to help us understand where we are is a initiative called the Carbon Risk Real Estate Monitor, which is a project that came out of was initially funded by the European Union. It's a kind of a science-backed project run by an academic group, and they are basically developing decarbonization pathways for real estate consistent with the 2-degree scenario. So what does that mean? Well, most governments in the world have now agreed to the ambitions of the Paris Agreement to limit warming to 2 degrees. And if that commitment is embedded in national policies, then that will have implications for the emissions in those countries over time. And so what this project does is basically calculate, given expected growth in real estate markets, given the energy efficiency of real estate markets today, how much do they have to reduce energy use, carbon emissions by 2050 to be in line with a 2-degree target. So it's kind of a scientifically derived pathway. And it's not, very few cities or markets will kind of follow that pathway in their regulations. But it gives you a guide, and it allows you to kind of understand if your entire portfolio is above the pathway and kind of underperforming the pathway, you can assume that it carries some additional risk. So we use that as part of our kind of preparing our buildings for net zero. But ultimately, it's about whatever emerges at the local level that impacts real estate. And then, of course, there are expectations to report on that, and that we see that more and more asset managers that we use as operating partners, or generally that we invest in through our listed portfolio, are reporting on their net zero targets. So what they understand as a net zero target, and where their portfolio is in relation to that. So what we would like to see is more standardization around how that reporting is done, and I think that will help everybody, because it makes the the information much more comparable. And that's a bit of a heavy lift because there are, in some cases, good reasons for definitions to be different across markets. But as a global investor, we really see a huge value in more standardization in that area that basically simplifies this for the managers and makes the information much more valuable.
Right. Anything we can do to simplify the complexity that we all operate in, multi-jurisdictional, multi-asset class, different hold times, it can be a lot. It can be overwhelming. And we had a polling question up, a couple polling questions up just recently, and the results indicate that the attendees in this seminar are either early stage, midway, or perhaps advanced in their climate change journeys. But for those companies or firms that are more early to mid stage, I just want to open the panel up to you guys and ask, what are the leaders doing? What are the basics? If you're not doing it today, you need to start right away. Like we have a lot of wood to chop here, right? So what are some best practices?
I'll be happy to start with that. And I'd love to hear what the other panelists have to say too. But a few things that come to mind, and I think this is a fantastic question. First one is that they're not designing their ESG strategy in a vacuum. They're doing things like a materiality survey. So they're really listening and understanding what's important to the stakeholders, what's most material to them, as well as looking at what their peers are doing and what the industry as a whole is doing. The second thing I would say is that they're ensuring that ESG is embedded throughout the investment life cycle. So starting from fundraising, making sure that they're talking about what their ESG strategy is. When they go to do a deal, is all of the ESG due diligence built into the evaluation of that deal and the decision around if you move forward? Once they close on that deal and now they're managing that asset, are they making sure that everything related to ESG is optimized? And then when it comes time to dispose of that asset, are they talking about the fact, and that's part of the marketing, that look, these are all the things we did from an ESG perspective. Another thing that I would say, and I think that Christopher was just kind of talking about this, is really being transparent about their goals and about their performance, whether that's through a corporate responsibility report, but really talking about what they're doing, not using marketing fluff, but really being specific about this is what we're going after and this is how we're performing against it. And the last thing that I would say is that I think leaders are doing in terms of best practices is they're really learning from one another. What I love about this whole concept of ESG or sustainability, whatever word you want to use, is the only way we're going to succeed is if we are in lockstep with one another and we're marching toward the same goal. If Jessica does fantastic on her net zero goals and I do nothing, we don't win. We have to do this together. We have to raise the whole bar of the industry by working together and collaborating together. So I think the best leaders out there recognize this and they don't see this as a competition. They see this as a collaboration.
Yeah.
Does anyone else have any best practices that they throw out there?
Yeah, I just wanted to comment and say, I definitely agree about the collaborative nature of this. And I think real estate is such a competitive industry that sustainability has always been one of these things where we can band together. And, usually it's, banding together against some, local regulation that doesn't make any sense, or, around, tenants that won't give us their data, and how do we kind of work together. But I think that's so important. And I think it's going back to the basics, right? And I guess Matt's going to love this. It's benchmarking. You need to be tracking your data. You need to understand what that data is telling you. I think that there's a lot of times where we say, oh, look, we're collecting all of this data, but then you're not really looking at it and like Chris was saying, okay, well, is this setting me on the right track? Is my portfolio positioned well for transitioning to net zero carbon, or do I have a lot of challenges? And really what we do is kind of like a tiering of our assets, where we say kind of the largest energy consumers and the most inefficient are that tier one, where we want to give the most attention to, go in, get those external audits, understand what the pathway is, and then kind of, different ranges in between, where everybody has a more targeted approach to how they should be focusing on improving those metrics. So first you need to get the metrics, and then you need to really take an analytic eye to them and say, okay, well, what are these numbers telling me, and what is my plan moving forward, and get that right group of experts in your corner. So whether it be the platform for benchmarking, whether it be external auditors or other technical assessments, making sure you have the right support network for your teams, because the last thing you want to do is kind of just drop this on a very busy asset or property manager and say, go solve this problem. You really want to give them that roadmap of what are you asking them to do.
I'm going to leave the comments on data to Jessica here, and I take a completely different tack on this, which is to change the mentality of the organization to perceive ESG as not a burden and a risk management purely process, procedure, or exercise, but to just try to change that arc, that this is a way to compete for dollars, that you can access capital differently, the green bond. You can find investors who want to pursue multitude of different returns with you, not just financial, but others, and attract more of their dollars and outcompete there. And that your customer, the occupant of this space, has recognized that real estate for most organizations on the planet is the focal point of their environmental and social impacts. And so they are now a partner and tenant engagement around this issue because of what Jessica's saying, not just getting their data, but also retaining them as occupants in your space. They need to and want to talk about this. So I really think there's a mental shift here that historically we thought this was a cost management exercise. And I think we've come so far to see really fantastic organizations like those in this call, Lisa, yours, Brookfield with the hiring of Mark Carney, really thinking about impact investment vehicles, right? Attracting dollars to new types of funds, issuance of green bonds, Boston Properties, Prologis, Digital Realty. These folks are all tapping capital markets differently to deliver superior returns for customers and having new and novel approaches to the tenant experience through shared interest in sustainability, health and well-being, et cetera. So these are about revenue, top line. They're a little bit less about bottom line expense management. I think that's a really healthy thing for the industry to think that way.
So then is doing good ESG costly? Like, do you need an army of 100? Like, do you need to rush to consultants, or, you know, oftentimes that is purported as the hurdle, right? So how is this myth or reality? ESG is costly.
Very quickly, just to follow what I was saying, it's about proportionality. The reward exceeds the expense. That's the thing to bear in mind. No doubt, we have more reporting responsibilities. We do have to have technologies. We need to possess this data and work with this data. But the benefits and the returns outweigh that expense. Therefore, we ought to go with it.
Yeah, if I can jump in here, I would completely agree with that. And I want to pick up on something Jill mentioned, that ESG is not done in a vacuum, right? I think what we've learned over time is initially, so we started investing in unlisted real estate about 10 years ago and developed a sustainability program quite quickly, and spent a couple of years kind of developing a framework, trying to understand what benchmarks were out there, right? We joined GRESB as a member and so on. But then real estate is a very operational asset class, and you realize that the key decisions are made close to the assets, and unless you both incentivize and motivate and empower people who manage the assets on a day-to-day basis to make these decisions, and what Matt said, to see the benefits of that over time, it's really hard to make progress. So this has to be, we realized quite quickly, it has to be integrated into the asset management process completely. And we've seen that has had huge benefits in how we do it, because the integration kind of reduces the organizational cost of doing this, right? Because it's a seamless part of the process. It's included in agendas. It's brought up in meetings with our partners. there are initiatives that are developed by the teams and kind of from the bottom, right, and informed on the way up or proposed. So it creates a much more dynamic approach to ESG. It doesn't depend entirely on a separate team kind of having sufficient influence across the organization. And of course, one of our key strategies is to invest with local competence and local market knowledge. And so a lot of this is driven by opportunities in the local markets. And so unless you have people, or unless the people you have following those markets also follow this agenda, then it's really hard to kind of keep track of what's happening. Yeah. So, on the question of whether it's costly or not, there isn't. If you do it right, I don't think there's a burdensome cost. And of course, we believe, at least over time, that it pays off in a variety of ways.
I can jump in on this question as well, because I think that a lot of times the cost is framed as far as like balancing with our fiduciary duties. And the way that I view it is taking this into account is our fiduciary duty. And so, you know, again, the non-financial factors that may influence financial performance, you have to kind of have a sense of what's going on there. And if you think about the amount of resources and costs that a financial services company it incurs managing the financial data, the accountants, the software, the auditors, all of the folks that are going into managing that financial data. And if we only put a fraction of that into managing the ESG data, what type of insights we would have, and the ability for us to be able to feel more confident in the decisions that we're making and be more transparent with our investors. And I do see that as you know, a key point in where we are right now, where people are seeing the connection and understanding that you do have to put some effort in, and there are costs associated with it. Definitely the cost versus benefit piece of it. And then I think the big part is just taking into the account the risk of doing nothing when you're talking about the cost at the actual asset level. We're talking a lot internally about kind of the difference between green premiums and brown discounts. So it's always been about, oh, could you get more rent, or is the building more valuable if we do this sustainability initiative? And now really thinking more closely about if you can't meet that objective, the potential for a brown discount or basic obsolescence, to where just nobody's interested in buying that building or lending or insuring that building. And so there's so many risks that if you're not paying attention could creep up on you and really impact financial performance. So tying it back to, is there a cost? I think the cost of not paying attention and not doing this is far greater than the cost of the things that we're asking to do.
Yeah, and I'll just chime in with a few other additional thoughts. So, and Lisa, when you kind of teed this up, I guess the question I would have is, how much is, you know, if people are saying, is this very costly to do? In their minds, are they thinking a perceived cost, or are they thinking a real cost? And so I think the onus is a little bit on us to be able to demonstrate the value, have the case studies. It's really a change management exercise, because we're moving from business as usual to now doing something different. And that always makes people, you know, whatever it is, a little uncomfortable. So I think it's for us to continue to promote the benefits and really talk about that and make sure we're really truly identifying the true cost. And I love what Jessica was saying about, you know, the cost of not doing things too. So for example, if we don't move towards net zero, we might have stranded assets, or we might be stuck with carbon taxes. You know, there's all these things that could happen. And I'm not trying to be an alarmist, but I'm trying to be a realist in terms of, let's be really prepared moving forward, and let's make sure we're bringing everyone along with us, and really being frank and transparent, and really talk about the wonderful things that are happening. And if they're not wonderful, let's band together to figure out how to make it better.
There was when I was at CB, we had CBRE Global Investors, right? It was real estate asset management, or CBRE Inc. And there was a fund in the States run out of Los Angeles called Strategic Partners, and they focused on owning office assets. And the fellow that led that organization remarked to me one time, this is 2014, 15, seems like ancient days and all. And he said, the cost of filing these different sustainability reports and getting this information up, he said, well, that might be tens of thousands, 50, 60 grand a year. I said, okay, not that I enjoy paying that. He goes, the cost to me of not being able to access institutional money is existential. And that was really stark, right? And I not to be alarmist like Jill, but there are many reasons to see serious negative outcomes. Like I cannot access capital, or I have a punitive interest rate on my loan, or I can't sell this asset for replacement cost. There's many reasons to think that those are realistic and near-term prospects for us. So can we de-risk a little bit, and is that worth then the cost that we're seeing in our businesses today? I would say absolutely. It's not free, but if you want to look at it in terms of just mitigating downside, there's plenty of ways to see why that pays.
I'm looking at the clock here and I realize we only have a few more minutes together. If there are any attendees who have questions, feel free to drop them in the chat, or if there's another way to raise your hand in this presentation. Otherwise, maybe we'll just go around and if the panelists can share one concluding thought, let's try to be positive here, a piece of advice or guidance. Maybe Jill, can I get you to get us going for the last round here?
I was worried you were going to pick me first because I'm like, oh gosh, what else? I mean, I think the thing is, this is such an exciting time. I mean, every time you turn on the news or you listen to NPR or you're, anything in the paper, it's all about ESG. And I don't think it's all gloom and doom. I find it incredibly exciting. I am so thrilled to be in this role. Who would have thought of 3 years ago there would have even been a title called Chief Impact Officer? So just the fact that it's important, and I don't want anything that we're doing to be driven by a GRES score or driven by what an investor says. I think we should take the onus of really knowing what's best for our stakeholders and do what's right for them. And then that should be the leading indicator, and then everything else will come. But I guess my advice is, be positive. It's an incredibly exciting time for anyone who's in this role. You have an opportunity to carve out what it is. Yes, there are standards we don't know and it's yet to be defined, but we can define some of this. And for us, being kind of on the forefront of a lot of what's next in this field, I think is incredibly exciting. So just enjoy the ride.
Jessica, would you disagree?
No, I was going to say, I was like, okay, what am I going to say? And I would have said everything that Jill said. And definitely the part about, it's an exciting time and it's not too late. It's not too early to get started. And those that are just getting started, there's so many resources out there. Look to others, peers, sustainability reports, look to different frameworks that are out there that are giving you an idea of how to do a materiality assessment, how to understand an ESG framework for your company. And really that piece, I'm reiterating a little bit of what Jill said, but there's no real estate company is the same, no real estate asset is the same. And so finding the right ESG strategy for your company, for your particular investments, everyone is unique, and really thinking about different opportunities to create value and how to mitigate risks in the future.
Christopher, we'll go to you, and then Matt, you get the last word.
Yeah, very quickly now. So I would just say, keyword is to engage. Engage across your own organization, bring people in, get their perspectives, and also engage externally. There's as was mentioned, there's a strong community of ESG leaders across different asset managers and investors in every market that are kind of essential to building knowledge and impacting change. So find those communities and engage with them, and then you'll learn a lot, and you'll also be able to influence things positively.
Yep. Positive note. There's two mega trends sweeping the industry right now. There's digitization, there's ESG, and they're affording us a chance to reframe our value proposition to our customers and our investors. And I think that's fantastically good, because our industry can be perceived by the public better than it is as rapacious developers or landlords. I think that leading on ESG is going to be fantastic for our industry, and I think we've done a fine job of it, and there's lots more to do.
Well, that will keep us all employed for the next foreseeable future. I see we're at time here. There's a couple of questions in the chat that have gone unanswered. Marina, maybe if you can get with me, we'll make sure we tie those out after the call. But I just want to say, thank you to all of our panelists, the attendees, to iGlobal as well for teeing this up. I had a lot of fun here. I hope you all did and certainly learned a lot.
Thank you so much, everyone.
Lisa.
Lisa, thank you so much. And thanks everyone for joining us and for taking the time to, participate in this discussion. A copy of this recording will be made available. You will receive an email with a link to download and save the recording. Other than that, again, thank you so much. Stay safe and healthy and have a great rest of your day from the whole team. Thank you all. Have a good one.
Thank you.
Bye-bye.